one word to describe the U.S. economy today?
I would say stagflation prone. We are moving toward higher inflation and slower growth both at the same time, which is a pernicious combination.
I'd like to welcome everybody to Buchanan's Counting Capital podcast. I'm Robert Brunswick. I'm the chairman of Buchanan Street Partners and very excited today with our special guest, an old friend. We're going to go back to school today on our program with what I would characterize as Sri-Economics, and you'll understand more in a minute what I'm really referencing. I couldn't be more proud to have Dr. Sri-Kumar on our program. He's an investor. He's a friend of Buchanan Street. And today you'll understand why Sri operates his own global macroeconomic consulting firm. He's got a great list of clients. He's a senior fellow with the Millikan Institute, member of the Columbia University's Graduate School Alumni Program, regularly published on Financial Times and the Wall Street Journal, WSG, and often interviewed where I saw him most recently on CNBC and Bloomberg. So a real treat today to have you. I've chose Sri to entitle our talk, if you will, as Macroeconomics in the Real World. So let's get started together and have some fun. I like to introduce our guests or have them introduce themselves by describing a little bit about your life and business background so we can understand how you got to where you are today.
Great. Again, great to be with you, Robert, and great to participate in the discussion with you and your investors. I started, again, with the education-wise, getting a PhD in economics from Columbia University. And the person who sponsored my dissertation, Robert Mundell, is well known in the international field, having got his Nobel Prize in 1999. He's known often as the father of the euro because he had the crazy idea in the 1960s that Europe could have a common currency. And people said, along with Henry Kissinger, when he became Secretary of State, whoever thinks that Europe can have anything to do in common, they always keep fighting with one another. And sure enough, we have the euro come into being, and the eurozone is a different point. So that is where I take off. Subsequent to that, my work with financial institutions, both with banks and asset management firms. And Robert, you and I were associated at TCW, Trust Company of the West. Prior to that, I was at Drexel Burnham Lambert in Beverly Hills. And the role was to try and figure out what it is that you can do with Latin American debt. We once had a visit from the CEO of Drexel Burnham visiting us when our group was new. And he told us, you guys are not junk bonds, you are toxic waste because you deal in Latin American debt. But what we found, and again, Mike Millikan to his credit, is that in the mid-80s, when everybody was shorting Mexican and Brazilian debt, that's where if you picked the right moment to get in, you could do enormously well. One of the things we did in the late 80s was to buy the Mexican telephone company at well below $1 a share, and then it traded about $5 a share by the time the debt was restructured. It had gone up about 10 to 12 times in about 4 years. So those are the kinds of things I do in terms of looking at country risk, not company risk. But you look at it top down. Sorry, Robert, go ahead. You had a question, it looks like.
I want to just bracket this a little bit. So just so everybody understands, your business model today at Kumar Global Strategies, your clients are pension funds, your clients are corporations that invest. Tell us who your customers are and what type of advice you provide them with.
The people who come to me are sovereign wealth funds. They are pension funds, as you mentioned. I even have an Italian real estate developer who wants me to write about What it is happening that Italy and how Italy is improving because it's generally thought of as a rock bottom credit within Europe. But they have done extremely well in the last 3 or 4 years, which again I foresaw when the current government came to office. Why is that happening? Again, it's a matter of risk analysis. You delve behind the statistics, Robert, and you say, when everybody says things are in bad shape, you say, yes, but they are going to improve. And that is where you get the benefit of country risk analysis and which countries to go into and which not to go into.
So, Sri, one of the things I enjoy about listening to you and reading what you write is you seem to be very nonpartisan and objective, and but you have your opinions, and we're going to certainly get into some of those today. But I do appreciate that, and the remarks today for everybody's benefit. I just want to make sure they know that that's the spirit and the perspective that you bring to bear in your remarks. So, why don't we dive right in to the Federal Reserve Chair and interest rates on the top of everybody's mind. And as I understand it, it appears that Powell is really more focused on the labor markets versus inflation at this moment. And that I believe that there's a correlation that by affirming these rate cuts, that he thinks there will be some correlation to the labor market. Now, that brings up a lot of other questions to bear, as you and I are going to talk about AI and that job market. But do you agree with this approach? And can you help us understand interest rates and correlation to job in today's world?
Those are great questions, Robert. First point I would make is that I am a firm opponent, and I have written in the last 2 or 3 weeks in my weekly reports that the Fed ought not to have two mandates. They should not look at inflation and employment. And the reason is, again, as a Nobel laureate, Jan Tinbergen, a Dutch economist, said, when you have one instrument, you can only tackle one objective at a maximum. So if you manipulate interest rates up and down, as the Fed does, you can either use it to manipulate employment or inflation, but you can't do both. What happens today is that the Fed keeps flitting between one objective and the other objective and does not get either of them properly done. Example, September of 2024, 7 weeks before the election, Jerome Powell declares that inflation is no longer a problem, but the employment market is soft, so he cuts interest rates by 50 basis points. And at that time, Donald Trump, I think rightly so, thought it was a political move on his part, even though the Fed keeps repeating that it's not political, it's independent. Soon enough, employment was not a big issue. Inflation headed up because they had cut interest rates prematurely and took down the policy rate by 1 percentage point between September and December of 2024. He's saying the same thing a week ago, that employment is the real problem, inflation is not. I think he's again making a mistake. And that is why I'm critical of the Fed. Two reasons. One, they are not as apolitical and independent as they profess to be. Second, you cannot manipulate both employment and inflation. Why don't you stick with controlling inflation and then leave the treasury to worry about employment? Because you don't do one job well, why should you take on two jobs?
Do you believe that with the adjustment in rates today, we will see a tick up or a drop in unemployment? Is that a fair diagnostic to utilize?
I don't think it is a effective diagnostic at all, and let me tell you why. They have cut interest rates in September. They're expected to cut rates again at the end of October. But employment is more dependent on what happens to tariff policy and what the Trump government is going to do in terms of business incentives for hiring. It depends also on artificial intelligence, what impact that has on employment. It has nothing to do with monetary growth or the interest rate. That is where I think they get it wrong. There is a history to it, Robert. 2000 September 2008, Lehman Brothers has just gone bankrupt, and you have the then Fed chairman Ben Bernanke then increasing the balance sheet of the Federal Reserve, saying that it's necessary at that time. It's going to put wealth in the hands of the people. They will spend, and the economy will recover. I say for wealth to go up, you need education, you need training. If you are a plumber and I double the balance sheet, you don't become a nuclear physicist. You're still a plumber. And so you cannot pretend that monetary policy can achieve goals that they were never intended for.
So, if I'm hearing you correctly, the goal of improving the unemployment numbers by dropping rates, you don't think it necessarily happens. And there's other reasons, which we'll get into, AI you touched upon, such that it could trigger and could be more impactful to bringing back that sticky inflation that we seem to have right now. Is that fair?
Absolutely correct. That is, you're spot on with the analysis. And Milton Friedman said long time ago that inflation is always a monetary phenomenon. That's exactly what I believe it is. But to use it to tackle employment, you're not going to succeed. If you use it effectively to tackle inflation, you will indeed be successful.
So talk about the Fed is constantly relying on their data analysis, but it strikes me they're really looking in the rearview mirror all the time in that analysis. So should they be more forward thinking and proactive in determining the path of rates, or that would be too much of a subjective projection, and they really need to focus on the data they have?
I'm going to answer your question in two parts. One, with respect to whether the Fed is looking at backward looking data. What they are looking at is data that is available to them and then interpreting it any which way they want to justify the policy they want to make. If you want to cut interest rates, you say that the data is indicating a softening labor market. If you want to increase interest rates, you suddenly say inflation has become a big problem. My point always has been that you need a firm doctrine, a principle that you follow. One of the professors in my PhD dissertation, who is still at Stanford University, John Taylor, is famous for something known as the Taylor rule. And he says, look at what is happening to employment, look at what's happening to inflation, and based on an equation, move the rates up or down. So, in other words, if inflation is above target, increase the interest rate. If your unemployment is above target, cut the interest rate. That is how you should behave. But the Fed is not doing that, because to do that means to give up their ability to shoot from the hip, doing what I call seat of the pants analysis, going to work one day and say, oh, I feel like I want to increase interest rates today, and another day, oh, I want to cut rates. The data don't justify that. Second answer to your question, we have not had any data in 3 weeks. The federal government is shut down. Where did Powell get the idea that inflation is no longer a threat? We haven't had any inflation number for quite a while. So the Fed lacks humility, lacks the ability to tell us that it does not have enough information. And when it does not have enough information, don't make a big move. Just desist from any move at all.
Brilliant. I like the way you frame that. Let's talk a little bit about politics and the reality of the influences of the administration on the Fed. I know the Fed prides itself on its independence. The current administration is very forceful and clear on their desires to see the Fed make some moves. So I always wonder, regardless of what party is in power, is there something to be said for more monetary policy being in alignment with fiscal policy? Why can't they cohabitate in these ultimate decisions on interest rates?
It would be wonderful if monetary policy and fiscal policy can cohabitate, if they both are well coordinated. But what often happens when that does is monetary policy gets subordinated to fiscal policy, which is what is happening today. How is it happening? The president and his people are going to increase the fiscal deficit massively by $3 to $4 trillion increase in the deficit over the next 10 years due to the so-called big beautiful bill that has been introduced. And there are a lot of tax benefits without a corresponding increase in revenue when the deficit was already a very sizable 6.5% of GDP when the president took office. So I don't think that works. So what does the president do? He wants interest rates to be cut because he thinks that will also bring down long-term interest rates and reduce the federal government's interest cost and reduce the deficit. So you can see how the fiscal policy is running the show, and they want the monetary policy to follow and be an obedient servant to the fiscal policy. Let me say one more thing and I'll stop. This is my fear that if you cut the short-term interest rate, which is the federal funds rate, which the Fed controls, you're not going to automatically lower the 10-year yield or the 30-year yield because they are set by the market. And if people in the market think that that's not going to bring down inflation, it's going to increase inflation, they're going to push up the long-term yield. The yield curve is going to steepen, and that's going to have a negative impact as far as all of us are concerned on inflation side.
I thoroughly enjoying your remarks in our conversation, and it prompts lots of questions, and I want to keep us on the track, but the federal deficit is something on everybody's mind, and I want to make sure there's lots of levers that can get pulled. So the lever of reducing the interest rate payments that the government needs to make is maybe not the right level for indications you've said. So king for a day, Sri, what are the levers to start to really make a difference in our federal deficit? Although, and I'm sure some of them might be very politically uninteresting, but from an economist viewpoint, what do we need to do?
What we need to do is, yes, you need to cut taxes to provide business incentives, but they need to be properly structured. That's one. Second, there clearly is a need to reduce the government spending quite significantly. And how could you do that? One way is, I believe that Social Security payments are taking up a good chunk of the federal budget. Perhaps you don't collect Social Security benefits at the age of 65. We are all living longer. We are all living healthier lives than our parents and grandparents did. Maybe you should wait until the age of 70 before you collect anything. But that's politically unacceptable to many administrations. Second, there needs to be an income check on it. Even though you contributed to Social Security since you were 20 years old as you were working, if you have a certain level of income, you cannot get any benefit. It needs to go to people who are lower income earning. And if you do that, that's going to help as well. So these are the various areas. If you do that, believe me, the long-term interest rate will go down because the people will realize that the need for future fiscal money raising is much less than it was before.
So you said the long-term interest will go down. Do you mean the federal deficit will go down?
Yeah, both. Federal deficit will go down because you have cut Social Security benefits, increased the age. And when it goes down, then the 10-year and 30-year yield go down with it.
Let's go to rates now and paradigms. Okay, so we're gonna have a conceptual conversation, you and I. I remember in the 80s, I'm aging myself now. I bought my first piece of real estate, and interest rates were 16.5%. And I was so fortunate to get that home loan and proceed with my life of building, equity in a home. So I fast forward and I pull up some numbers and I'm going to get them close. So if you kind of look from 1990 to 2024, the average 10-year treasury has been 448. The 10-year treasury today is four, just under four. I think it went under today. Jump to the 30 for that same time period, the average rate was 5.08. Today it's 457. Are our expectations out of whack as to how low rates should be? And so that's A. Now marry that with the paradigm shift of young people today. Maybe they don't want to own a home like Sri and Robert did way back when, because they have different aspirations of building equities or having a freer lifestyle, not being tied down to a mortgage. So help us frame how low interest rates should realistically be, because everybody wants to say that the housing market is not going to move until we lower the 30-year treasury. So I don't necessarily think that's the only trigger, but give me your perspective on this.
The 30-year treasury is one influence on house buying ability, but clearly there are others. And which is, what is the shape of the economy and how healthy is it? And what you want to do there is to create jobs, have the economy growing at a steady 2.5 to 3% rate. And you want the fiscal policy to be predictable. What we have had since the current administration took office, there is no predictive capacity because tariffs are imposed on one country is friendly today, tomorrow it is not. When you do that, that is going to affect employment and house buying ability eventually. And the reason is because there is uncertainty. So if I am in a profession and I am going to do well, I think, before the tariffs were imposed, and suddenly I find the imposition of tariffs has cut the business ability of my employer, I'm not going to buy a house. It has nothing to do with interest rates. It is something that I fear because of tariffs. So it's a compendium of different risks that you have to take into account to decide whether you're going to buy a house or not.
That was perfect. That was a great way to frame it. So let's jump into AI and trying to put a bracket on AI. As I think about it, it is certainly going to affect employment, and you can discuss that, and both the belief it's going to make us all more efficient and ultimately allow for different types of jobs. You could argue that many jobs could go away also because of this efficiency that AI brings to bear. But broadly, is AI fueling a growth that warrants what's going on in the equity markets today? Or is this too just dot-com bubble 2.0, and most of the players in AI will fall off and there will be some assimilation of efficiency, but not necessarily the outcome that we're all projecting right now in this equity market pricing? So there's a AI to employment question and an AI to the equity market question. So have some fun with both of them.
Let's start with AI and related to employment. And is it employment generating or is it employment destructive? And my answer to you, it would be it is both. If I, for instance, somebody wrote to me recently saying, aren't you happy you're not 25 years old today, looking for your first job as an economist in a bank? And I said, I really, really believe that to be the case. I had no competition from anybody. There was a big demand for people with knowledge, and we had to do the work ourselves. Computers were still at a pretty elementary stage in the mid 1970s when I started to work on that. On the other hand, today, fast forward, I don't need the 25-year-old to work for me because I can use AI, and I do use AI in my work and my report writing. And I can use the Google, I can use the computers extensively to do my research. So it has obviated the need for certain kind of labor. However, still sticking on the employment question, Robert, before going to equities, I'm going to hire more people who are computer savvy to do the kind of work which I would not have looked at 30 or 40 years ago. So if you are AI savvy and knowledgeable, you're going to get new opportunities today, and you're going to do very well financially in terms of what your earning capacity is going to be. So that's the big benefit. Move over to equities. That's a simpler answer to give you. I think there's a lot of hype in it. And you mentioned, is it like the dot com boom in your question? I think it very much is. I remember 1999, where you were told that anything which had a dot com, earnings don't matter. And they can sell for any valuation because it's a dot com. And of course, by 2000, 2001, when the crash came, it took down that thought along with it. I think we are going to have something similar happen in 2026, let's say, when many of these AI oriented firms do not succeed, only a few of them come to the top. So, the advantage or the challenge for your listeners is going to be that they have to locate, or their money manager has to locate, what are the likely successors? You won't pick all successful ones. You may make some mistakes in your choice. But if you pick five of them, you want at least one of them to be a barn burn success, even if four of them are mediocre or turn out to be failures. So many of them are going to fail, and you need to be very selective in which companies you pick and what management you like.
And as prudent investors, Sri, and putting a certain amount of our investment dollars in the asset allocation model to equities and continuing to do that and not trying to pick the right time to invest or sell. Um, the AI halo effect on the greater equity market is it really separated with just those 7 to 10 or more AI players with PEs that are silly, and the balance of the market, it has a reasonable PE ratios such that we can continue to deploy in the equity market as being thoughtful to that segregation? Or do we need to take a step back and wait for the dot-com bust to happen before we go back into the equity markets?
I think it is the latter, that there is so much hype. You're more likely to make a mistake in AI by rushing in, thinking that I know this company is going to do well, even if the others do not. And I think you would be better off. You can always put a small percentage of your investment allocation into those AI companies, but anything significant, I would wait until there is blood on the street.
But what about the other companies that aren't AI related, just the block and tackle industries? Are they have they risen because of this AI halo such that you can't invest there also? Or can you segregate away from AI into other or business models?
The other companies which are not centrally connected with AI, they may still depend on AI for their improvement. And let's say that the presence of AI, it is a food manufacturing company, let's say, nothing to do with AI, but they use AI a lot in their work, and they have been able to boost sales or cut cost. So, yes, clearly, if you go get behind the numbers and see what the management is doing, there is an opportunity for you to make an investment in that food producing company benefiting from AI without necessarily being in AI itself.
And my guess is that's the bet that a lot of people are making and continuing to invest in the equity market. And why we're seeing it rise is because there's the belief that AI is enhancing their productivity and efficiencies. So there you go. So let's switch over our conversation to gold and what it's done here recently, and as it relates to the weakening dollar and the belief that that our world currency of the dollar isn't maybe as predictable as we would hope. And how does this all affect interest rates with what's happened with gold, and the drop efficiency of the dollar?
Your question is very timely, and I will tell you why. Normally, under a situation like this, you would have expected the dollar to weaken with all of the tariffs imposed and the money going away from the United States. And you would have expected the 10-year yield, the 30-year treasury yield to rise sharply from April onward. That has not, neither has happened. The dollar, after weakening quite a bit, has started to strengthen recently. And as far as the 10-year, 30-year yields have come down, as you said before, they have come down significantly due to a fear of recession, fear of economic slowdown taking place. That's where the gold comes to the forefront. Gold is playing a role today that it has not done in my experience as an economist since the early to mid 1970s. So you're talking about something that happened 50 years ago. Gold again came back to life. It came back to importance at that time as an alternative to other assets. Today, what is happening is that there is a flight not only from the dollar, which happened initially, the dollar weakened and the euro strengthened, for example, at the beginning, since the beginning of the year. But you also have a flight from all currencies. What do you do when you don't like the dollar, you don't like the euro, you don't like the pound sterling, and you don't like the yen? What do? You go to gold. That again was what Bob Mundell, my mentor, would have said, namely that gold is ultimately the final currency, it's your store of wealth. And it is benefiting significantly from that taking place. And if you want, today the gold price has come down in the fear that it has gone up a lot. But if you want gold to come down significantly, you need much better thought out monetary and fiscal policies, which we simply don't have yet.
Makes sense. All comes back to that. So, amateurs like me might want to attach a moniker to the state of our economy and what we've been talking about today. So, words like stagflation, recession, sticky inflation. How would you phrase where we are going in your prediction to help us utilize some attached naming of it?
Let me make a few assumptions. Let me assume that the president and his administration stick with the high tariffs, that they don't go back to the Biden era of a much lower tariffs. Let's assume the tariffs are going to stay, which seems realistic to assume. Let us also assume that the interest rates are going to be reduced significantly for two reasons. One, Jerome Powell's term is coming to an end in May, and the president is going to nominate his successor who is going to be looking for much lower interest rates. So if you put the two together, it says to me that you're going to push up the long dated interest rates higher as a result of cutting the short term interest rate. That to me says that inflationary expectations will remain elevated. And that is where I think we are headed over the next 12 to 18 months. Looks like you have a question.
Your view then is sticky inflation, reduced interest rates, but continued growth.
Sticky inflation, but then again, with much higher long term yields, lower growth. Because now what has happened is you have a sticky inflation, your salary is not going up to the same extent. And what you have are mortgage rates have gone up. And that is putting and anything that you want to do in terms of you want to buy a car, the car prices have gone up due to import tariffs, and they are also going to cost a lot more because the interest at which you're going to borrow has gone up.
So with this thesis, given the conditions that you predicated this on, I would the rate of the 30-year treasury today at 457 or the 10 at 4, and if you wanted to go out and borrow long, you should probably do it now if that bet came through, because you're believing those will go back up. Is that what I'm hearing from you?
That is exactly right. That's exactly what I'm saying. The counterpart to that, Robert, what should you be doing with your own investment money, your investment allocation? I have said on the long term side, do not go into long term, long dated paper. Stay more within 1 year or less on the fixed income side, because you'll always have a time at which long-term interest rates increase because of inflation fears. Then you can go in and lock in your presence in 10-year or 30-year securities.
So before we go to investment allocation, which you're going to get, you're going to share with us, I do want to make sure. Can you box the tariff thing simply as to pros, cons, and its implementation as we see it today with today's administration?
I see very little pros from tariffs. I am a free trade person, and I think you can achieve a lot more if you don't like the tariff, whether it is the Chinese you're quarreling with or the European Union, that you would be better off going to your trade partner and negotiating better terms for both of you, rather than unilaterally saying, I'm going to impose a 50% tariff on all your products. So that's something that I do not like as a policy, and that I think would be destructive of both parties. In other words, the United States as well as the European Union. So that would be the first part. And what was the second one you wanted to raise again?
Yeah, no, it was just the tariffs and their, well, I wanted, do you believe there's a direct correlation, and are we seeing this tariff policy help with manufacturing development here in the US? Is it correlating to the big bet, which was manufacturing here?
I don't think it will. And the reason is twofold. One is the assumption often made by the Trump administration is we impose tariffs, the United States is dominant, the other countries will not retaliate. If you impose tariffs to prevent, let's say, German cars from competing in the United States, is it going to be an unalloyed blessing for General Motors? Well, tariffs on metals have been aluminum, steel have also been increased substantially, which are used by US auto companies. So they are going to benefit. They are going to cut back on the employment when that happens. So there is no direct correlation between imposition of tariffs and expecting that to have a positive impact on manufacturing or your ability to create jobs.
Sri, you go to, you live in the world having all this knowledge and having this sense of perspective with economic history and things we've seen before, we might see again. So as you think about today and you think about constructing your own investment portfolio or advising others on how they might construct their portfolio. And again, let's be agnostic to age right now, because that would certainly have some factoring into that portfolio construction. But how much you construct a portfolio given the world that we live in today with all the things that we've been talking about?
I would say, again, the traditional 60-40 portfolio, as it is known, 60% of your assets and equities, 40% in fixed income, and simply moving your assets between the two of them no longer works. I have been saying for the last 2 or 3 years, you need to have alternatives. Real estate investments, for instance, is something that I have recommended repeatedly. Have a well managed global real estate portfolio. Why is that? Because they cater to different priorities and they react to different factors compared with your Google stock price or General Motors stock price. That's one reason. Second, the stock prices vary from day to day, and you have to decide whether you're going to hold on to it or sell it tomorrow. Very many of the lockup investments where you have gone in and taken advantage of the presence, you're going to benefit from it. I mentioned to you that one of my interests is Italy, for instance, because of my having a client interest there. And when I stuck my neck out in 2022 and said Italy is going to do better rather than worse under the Giorgia Meloni administration, which is continuing today, people said, "You're going too far." I had people who were in Europe who disagreed with me. Today, what has happened? The Italian bond yield compared with Germany, which is the way they measure risk, was 250 basis points in October 2022. Today, it is 80. And why did I stick my neck out? Because the European Union told Italy that you need to stay in the fold if you want to get money from us. The European Central Bank said, if you want us to keep buying Italian paper to prevent the yields from shooting up, you have to stay within the fold. And those kinds of moves have been positive. I looked at them and said, this, even though Giorgia Meloni came from the same party as Benito Mussolini, Silvio Berlusconi, she's not going to behave the same way. And it essentially has paid off.
As I think about the alternatives bucket that you just alluded to, you talked about real estate, but just frame for people, when you say alts, what could be in that basket of alts for Sri and his investment portfolio?
Real estate, we mentioned, can be one part of it. The second is distressed debt as another one. I have often mentioned commodities, including gold. And I said on a podcast at the beginning of the year when gold was at about 2650 per ounce, I said by July it's going to hit 3700. It not only hit 3700, today we have gone over 4200. So it has gone up, and I had said that should be part of your portfolio as well, not just equities and fixed income.
Sri, I could do this for hours with you. It's my curiosity is piqued, and there's so many more questions I'd like to ask you. But moving away from maybe, we got right brain, left brain, right? So, how do you, in your day job and when you talk to the world, balance your own, your own personal views, experiences, beliefs, with maintaining objectivity as you advise and look at the economic, playing field out there. We all are, you're not a robot. We're all influenced with our own personal passions and interests and beliefs. So how do you balance that?
That's a great question. Um, I'm not going to pretend that I'm totally independent and that when I come to work, I forget my personal life and I'm only looking objectively at the numbers. What you try, though, is to try your very best to keep them distinct. And one of the ways you do, Robert, is something you made reference to. You say, I am apolitical. I don't believe in one party or the other party. And sure enough, I get emails and solicitations from both the Democratic and Republican parties because neither of them knows which party I belong to.
Yeah, it's very funny. I agree.
And during the Biden administration, I was very critical of the big increase in the government spending. I thought it was going to cause inflation. I was critical of Jerome Powell and his policy of cutting interest rates prematurely in 2021, 2022, despite economic recovery. Turned out to be correct moves and correct expectations. So suddenly they said, aha, you must be a Republican because you're very critical of what happened. Now I'm saying negative things about the imposition of tariffs because I don't like it. So the way you do it is you can never divorce yourself completely from your personal life, but you think about to be as unbiased as you can be in terms of trying to keep economic principles and political ideas and which way you think they're going to have an impact. And if you do that most of the time, you're going to be successful as a predictor, and you're also going to be very helpful to the listeners because you have tried to give them the idea you're unbiased. And when I go on TV interviews, the Twitter responses often come and say, I want to listen to him because he doesn't have any particular party preference. And I say that is a big compliment for somebody to say that you come out without just being a Republican or a Democrat, but saying, I like this policy, I do not like the other policy, I don't care who put the policies through.
Well, beautifully said. I will call it best ideas, and you framed that the best I've ever heard it framed. And you're not doing it just to say it. That's the way you live your life and you conduct your business. And it's very. When I listen to you, that's exactly my takeaway. Great objectivity. So as we look to close down our session together, I'm now getting to know you a bit more after we haven't connected for some period of time. Balancing life work and thinking about your discipline, you're continuing to charge at this stage in your life and be accretive to all of us. But how do you balance life and work in your day to day?
The best way to suggest work life balance is you decide what it is that want to get out of your personal life. You have a family, you have children, or in my case, also grandchildren, and you say, this is what I want to be as a good relative to all of them. Then you fit in, I think I would say, then you fit in the business portion of it. If you begin by saying business is what is important and the rest of the family have to cater to whatever my needs are, I don't think that's going to work. I may not be giving the advice which suits everybody, but I think if you start out from a personal, and that personal doesn't mean selfish, personal means all comprehensive relationship with people who are near and dear to you, and then you bring in the business life and try to see how they all fit in. I think that would be the way to get a work life balance. Why is that? Why do I frame it that way? Because you're going to move a little bit here and there within that compendium. You're not going to always say personal life is 60%, work life is 40%. It may be the other way around. But to the extent you're flexible, but you keep both of them in mind, I think you're going to be successful in keeping them in good balance.
Wow, what a great takeaway! You're a wise man. You should write a book on philosophy. I love.
Thank you.
With that answer, I do want to have you give some words of wisdom to our younger listeners because we have a number of them that are thinking about their career and their life. And what might you offer them as they think about building their career in today's very complex world?
Again, start off. I'm assuming that you, the young person listening, already have had some education in a certain area. If you are in science, technology, then find out which area you're going to do very well in and then improve on it. Let's assume, on the other hand, you are in finance. Then try to find out what areas of finance you're most likely to succeed in and where you should be. In other words, I would say get some thought from the markets on where the need for going is going to be, demand is going to be from now till 10 years from now or 15 years from now, and orient yourself toward that area. You can do well being a scientist or an engineer, for instance, or you can do well as a finance professional, or you can do as a lawyer or a doctor. But in any case, you want to specialize. And if there is one word I would emphasize, it is specialization is going to be important. Why is it important? Because AI is going to compete with you. Other people are going to compete with you. So you better have a skill that is unique to yourself, whether you choose to become a doctor or a lawyer or an economist. Does that answer your question?
Beautifully. Yes. I love it. And I'm sure there's going to be a lot of note taking and take home value for folks on those last two questions, surprisingly, because you would think you're hearing from a macroeconomist with your resume. There's going to be a lot of data, but I think your closing remarks were beautiful. So thank you. A lot of take home value today. We're going to have you back on our program. I've no doubt that our listenership will enjoy your remarks and thinking them through and making some decisions in their own life with investments and their outlook on the economy. So thank you. And with that, I appreciate everybody joining us on County Capital Podcast. Look forward to our next episode together. Thank you very much.
Thank you for joining us on this episode of the Counting Capital Podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice, nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.